Hello, hi. Hi everyone. Thanks for joining the call. Um, we will start the call in 2 minutes. Uh, we have Hitesh sir with us, who is our senior fund manager, and he'll be going through the market outlook today. We'll just wait for 2 minutes and we'll start the call. Thank you. Yeah, hi. Hello everyone. Hi. Thank you for joining it for Abacus monthly market outlook on a Wednesday evening. So we will start the call. And Hitesh sir, who's our senior fund manager who takes care of our PMS and AIF, he'll be going through the market outlook and give you, and later after the market outlook, we'll go through a brief about the portfolio that we work on. And then we follow after that, we'll take care of the Q&A part. So, Hitesh sir, thank you for joining and please take it forward. Thank you.
Thanks, Shailesh. Good evening, everybody. Welcome to the monthly market outlook. It's clearly been a difficult, if I can say, couple of past few days. But I think that's just the nature of the market, and which we are in currently. And just to sort of recap, we are in January 2026. Just to recap how calendar 2025 has been, it's largely been an year of consolidation. We've had a strong run post COVID, pretty much. Markets are never fairly valued. They either are undervalued or they are overvalued. So they did run ahead of themselves. And since the past 16, 17 months, we've been in some way or shapes, seeing this consolidation phase. And it comes due to various reasons, an immediate earnings slowdown, which the market could ignore for 2 3 quarters, but suddenly it realizes that earnings are not coming but valuations are high. Or it could come across geopolitical headwinds. For example, this whole Trump thing, this whole tariff thing, 50 to 25% tariffs initially, which were increased to 50%. Slowdown in consumption, slowdown in domestic corporate earnings, which people realized with a bit of lag. And the other bit was global markets looked more attractive than India for this sort of, for the growth that we were having domestically. We were richly valued, and the investors moved their monies elsewhere. The other factor was a lot of money in liquidity in the market was diverted towards the primary market. So, we didn't invest in stock. We sold essentially existing stocks, or our existing holdings, which put pressure on the market. And what did we do? We bought it in the primary market. So we raised 1.9 lakh, almost 2 lakh crores was raised through more than 350 IPOs. This was against what we did in CY24 was 1.9 lakh crores. So we did 1.95 lakh crores this year. So that also takes away a lot of money. That entails, a lot of selling from your existing shareholdings. But against these headwinds, I think we didn't do as bad. We were relatively okay thanks to some of the policy measures, both monetary and both monetary and fiscal measures. So, across over the course of the year, repo rate was cut by 125 basis points. Around 11 lakh crores was put in, or that order was put in through FX swaps, OMO. So that was a order of liquidity injection that was done by the RBI. So those were the measures that were, or the CRR cut. On the fiscal side, we saw the income tax cuts announced in the budget, so up to 12 lakh. Essentially, you don't have to pay income tax. So that was a significant move. So make essentially try to spur consumption, more money in the hand of the Indian consumer. So that was the idea of the budget last year. And the other bit over the course of the year, that was in September, was to, again spur consumption by reducing the GST rate cuts. And we saw significant, so essentially with the GST was essentially there are four buckets, largely we moved to two buckets for the GST rates. We did see the benefit of the consumption thing in the festive season in the auto sales. We've seen significant jump up in the auto sales in the during the festive season, and that sort of momentum also continues. We've also did see a spur in overall consumer demand during the festive season, and we hope that this trend continues. And we've also seen an increase in discretionary spending over a high base of the last year. So we that discretionary spending continues. So which is a positive. So so that was 2025 calendar year. Now, how are we positioned for 2026? The important question that is there. I mean, after the sharp fall that we've seen, after the sort of a lot of the confrontational attitude by the US government, President Trump. So, there's a lot of fear in the markets. You've seen it, that sort of meltdown happening, sort of the market fall quite sharply yesterday. So I think uh, so there is a lot of this noise. There's a lot of this fear, but I think domestically we are, from a macro standpoint, we are placed reasonably well compared to other geographies. Okay. So importantly, the income tax rate cuts, the GST rate cuts, uh, and the monetary policy measures that have been taken by the RBI, the benefits of these come with a lag. So, over the course of the later part of last year and in this year, we should see the benefits of that, and consequently better tax collection. As there's more spending, there'll be more tax collection. So some of the losses that the government had on account of the lower tax collections should be more than made up by the increased spending. Uh, so that was one. The other bit is the other bit, important bit is the low inflation levels that we've seen. That should aid purchasing power. The CPI inflation, if you've looked at the data, ignore the, and we'll discuss that in later. Inflation is virtually zero. It can't stay at zero for a long period of time. It will normalize to 3.5 percent over the course of the year. But what has at least happened is lower inflation levels in these relatively not so easy times have aided purchasing power. Corporate capex cycle again should regain its mojo in FY27. We see increased demand on track. It is in select sectors. It wouldn't be across the board, and I don't think so that trend will happen. It will be incremental wherever we see demand. A lot of the capex has been postponed because of the global uncertainty, this whole tariff situation. But corporate balance sheets are clean, so there is the ability to take on debt. Equity markets, anyways, are liquid, so there's mojo in the equity markets generally, and we've seen that via the the primary issuances that have happened. We've signed FTAs with the UK, New Zealand, and are looking to sign an FTA with the EU, which is called the mother of all FTAs. So that should spur growth. Again, situation with US is at the moment is difficult. It's very difficult. It's sort of at its peak, but we expect over the course of the next few months, this situation should also increase. Again, and on the other side, on the rural side, demand is expected to be stable. We had a good monsoon season last year, thanks to which reservoir levels are high, which implied a strong sowing season for Rabi. So agri incomes are good. Non-agri spending in the budget was there, so again that helps. The just to add icing on the cake, metal prices are high, so precious metal prices are high. So higher monetization of precious metals or gold essentially via gold loans should aid consumption. So all these parameters do help. Valuations have become more reasonable. So again, that is sort of in that sense helps us. We are not in the overheated zone. We've corrected significantly without any major change in the macro. So which does help. Budget expectations are low. To be honest, budget expectations are low. But that could be the trigger for us to get a positive surprise. We should see, we expect the government to tread that path of fiscal cautiousness, fiscal deficit to be in within its budgeted target, and we'll discuss those numbers later. It could do some measures to spur export growth, make it more export friendly, given the FTAs that we have, makes business environment easy, etc. Make FPI investment easy, open up FDIs in more sectors, or make FDI investment easier across sectors. Given the pressure on the rupee that has happened, so you need to attract more flows. You need to have make your exports more attractive. So to all those measures will help to stabilize the rupee. They'll also, and on the back of the fact that we've got already FTAs that we've signed with UK and New Zealand, and hopefully by the end of the month, we should have some form of an FTA agreement with the European Union as well. So now some measures around export attractiveness should also be there. That's what we are hoping for. Just on regards to what has been the performance of the Indian indices and how does it compare with the global indices over the last few years. So obviously our mid cap and small cap indices have done exceedingly well over the last 3 years. These are the numbers on a cumulative, i.e. a total return basis. These are not CAGR basis. These are on a cumulative local currency basis of that currency of that respective currency, country. So on a 1 year basis, our and our Nifty's indices have been in the double-digit range. Mid cap has been around almost flattish, while the small cap did give up some gains but still on a cumulative basis, we are relatively strong. Within the mid cap has done a cumulative return of almost 90%, while the small cap 250 index is around 67%. But if we compare the 1 year returns to some of the other countries, and those being specific factors over there, for example, on the back of this whole AI semiconductor thing, Taiwan and Korea and the US have done exceedingly well. Germany has done exceedingly well on the back of fact that its valuations were undervalued and they hadn't done anything for a long period of time. That's also been the case with a lot of European countries, etc. But on the other major EM economies, India continues to do way better. Uh, so that is that. The other bit is the currency depreciation against how has the uh, rupee performed against the dollar. So the rupee has been come under a lot of pressure, largely on account of FII outflows, and we'll discuss those numbers as well. And also, one of the other bit is the tariff-related headlines. So both are in some ways interrelated. Though FII outflows is also on account of higher valuations of the Indian equity markets. So a bunch of these factors led to the depreciation of around 5% of the rupee. On a actual basis, it is given the interest rate differentials, it is not too bad, but the pressure on the rupee is still there. Having said that, even today, I think the rupee depreciated. Having said that, the currency is now undervalued on an RER basis, so real effective exchange rate basis. The currency is undervalued, which implies that the downside from here on would be limited. So that is comforting, and the stability in the domestic macro does provide a lot of comfort to us. Our forex reserves continue to increase, especially on the back of the fact that gold prices continue to rise, so which is obviously gives us benefit. So our reserves do continue to increase. So from that angle also, we don't have any problem, and the domestic macro is fairly stable. So this is a point where we can actually take the pain of the rupee depreciation, if I may say that.
Hitesh sir, sorry to interrupt. Can you just zoom in the screen? I'm getting comments that they are not able to see it properly.
Is it better?
Uh, can you do just
Okay.
little more?
Did it improve?
Yeah, much better.
Did it improve?
Yeah, much better.
Much better. Okay. Sorry.
Thank you.
So the other bit is yeah. So one was we discussed about the rupee. One of the major factors for the markets behaving the way they have in the last year and the rupee depreciation has been recorded to the FII selling. So, on a cumulative basis, I think these numbers are in dollar million. So we've almost seen $18 billion of, FII selling in over the last financial year. So 18 billion, that's a significantly large number compared to other years. But the good part, what has been the stabilizing factor is the significant buying by the mutual funds, which is an unprecedented amount at 57 billion. That is an unprecedented amount. You've got the numbers ahead in front of you. So over the last couple of years, this number 24, 25 have seen significant buying by the domestic investors. The likes of AIFs, PMS, and the mutual funds, of course. You've seen significant buying, but at the same time, the scale of selling of the FIIs also has been significantly higher. So the early one of the remarks that I was making was there's been a lot of investment in the primary market. Record investment in the primary market in CY24 and CY25, which is again reflected in the primary market numbers of around 14 billion in CY24 and around 8 billion in CY25. So there have been buyers in the primary market, but FIIs have been sellers in the secondary market, and significantly higher numbers at 26 billion in CY25 versus 15 billion in CY24. So it would also be interesting to look at how have FIIs behaved in other financial markets. So the relative scale of market capitalizations, etc., for different markets is different. But leaving that aside for the moment, how have they behaved in other, how they behaved in the other markets does give some idea. So while in India, we're looking the order of 17, $18 billion, uh, uh, you've seen almost similar behavior, but for Brazil, in other markets, including Indonesia, Malaysia, South Korea, post a very strong run in 2023 and 24, and in Taiwan, etc., Taiwan, Vietnam. So each country has its own different history, but India, yeah, for a fact, has seen significant selling this year compared to the other peers. Uh, and in general, a lot of money has moved to European markets where valuations were lower, where you had this, and to the US, of course, back, where you had a lot of AI related capex flows, relative undervaluations. So those were the things that drove global flows last year. You'll just move to market outlook. Uh, how have India GDP been? How have India GDP numbers been over the last quarter of the last recent periods? We've from a GDP standpoint, we've done exceedingly well. Actually, from a real GDP standpoint, real GDP has surprised us. Pretty much all market observers, real GDP did surprise us. We were looking at around, we've got a number of 8.2 as a GDP for Q2 FY26, annualized on a YOY basis. But the some of the sort of the balancing factor is given the low inflation numbers, the nominal GDP has also come at an sort of, but for COVID, it almost at an all-time low. But ultimately, real GDP matters. The problem with the nominal GDP being so low is that corporate top lines will it does reduce your purchase, power to increase revenue, because when the nominal inflation rates are actually low, inflation rates are lower, corporates cannot actually have reduced pricing power in that sense. So you will see for the last couple of quarters top lines being weak, given that the nominal GDP itself is sub 10%. So, in that sense, revenue or top line will be lower. So that is actually sort of impact of a lower inflation or a lower nominal GDP. So this is something we have to live with. But inflation numbers are transient. We have a low base this year. So going into CY26, we should see inflation backing up to 3.5%, 4% levels. So, but this is just one fact to keep in mind. I think the other important bit, and what we've discussed in the past as well, is our GDP growth rate numbers are significantly higher compared to the developed world. Okay, so over a period of time, our so where the Western world is growing at, say, 1.5%, depending on which country or eurozone or you're looking at Japan. America is doing currently slightly better. Uh, Over a longer period of time, we are significantly diverging. So as we compound at, say, 6.7 or 7% or 7.5%, while the Western world compounds at 1.5%, we are narrowing the gap over the next 1 or 2 decades. So I think that is a significant takeaway. Our rate of compounding is significantly better than the Western world. So at some stage, our GDP numbers, our living standards, etc., should converge. So this is, I think, over a longer period of time, this is an important takeaway. So I think I'll just discuss some of the important bits that we have. One of the important bits is, so one was, as I said, India inflation has come significantly lower this year. So CPI 5% against RBI's target of 4%. Having said that, this is on the back of, a good monsoon, strong agriculture growth being strong, relatively bit, so supply side being strong, demand side being slightly weaker. But over a period of time, especially given the low base, and also the other bit was oil prices being very benign. Oil prices being benign, this has helped the inflation numbers to come lower. But as I said, over a period of time, as given a low base, you should expect inflation to go back to RBI's limits of 4%. So largely we'll be around in 2026. We should be around in the 3.5% range, and then probably go. The other bit is. But having said that, so the other bit is repo rates. So currently we are at 5.25 after a 125 bips cut over the course of the year. The lower inflation should give RBI room to at least cut rates by, in my opinion, rates by another 25 basis points. So that should continue to spur credit growth in the economy. GST collections, while would generally been strong, they did take a knock off because you simply reduce the rates. But over a period of time, the net benefit should be positive, given the multiplier impact. But in the near term, at least, we've seen some dip in the GST collection. Rates continue to be steady, so long-term rates continue to be steady. So there's nothing worrying there, as against something like, because our fiscal deficit is largely under control, unlike Japan, which has, where we're looking to raise the debt, increase the debt as the percentage of GDP. So unlike some of those countries, our 10-year bond yields continue to stable, which is just reflects a stable macro picture. And the other bit is crude oil, and crude oil continues to be hovering around the 60-65 mark, which is again good for an importer like India. So that is, I think on the macro side, as I said, we continue to be positive. The consumer sentiment, if you look at it from RBI's perspective, we've seen a moderate pickup as this chart shows. And though this is both across, if you look at all India basis, whether you look at rural or urban basis, we continue to do well. So barring the slowdown during the middle of the year and then all the measures that the central government took, I think we are again on an uptrend, so which is again a positive. As I said, the CPI inflation, which is all, if I exclude precious metals, which is gold and silver, which have significantly shot up. So it's despite that our inflation numbers were sub 1%. So if I exclude the CPI inflation, gold and silver, we are in a slightly deflationary territory. But I said I wouldn't read too much at this point in time for the simple reason that it is a bit transitory impact. We've had a good monsoon. We had a good supply of fruits, vegetables. So the food inflation was also benign. Some of these things will, autocorrect, and we should be back in a very comfortable zone of 3-4%. The other important bit is capex. So I think the capex bit is underappreciated. So I just wanted to highlight, post COVID, our capex as a percentage of GDP has significantly moved up. Pre-COVID, or we average around 2 to 2.5% as a percentage of GDP. Our capital expenditure spends were of the order of 2 to 2.5% of GDP. Post-COVID, we are currently, we've been around 3.1, 3.2, which on a relative basis is significantly higher. So it's not only your GDP that is nominal GDP that is compounding more than 10%, but a proportion of that, but you're also spending a higher proportion of that. So you're spending a higher proportion of something that is compounding uh, uh, by more than 10%. Uh, and the important bit is how much have we spent? What is the growth rate on a YoY basis? How much we are spending? Over a 2-year period, our capex CAGR, if you just look at public capex, it has been 15%. Again, private sector capex, while everybody complains private sector capex, and it's a bit difficult to measure, but by some measure of looking at top 1,000 listed companies, the 2-year CAGR of private capex has been 14.2%, which is not disappointing. If I look at public capex for the first half of last year, first half of FY26, so you've got the benefit of a low base of last year. If you look at that, you look at a number of around 17%. Private capex, if I look at the first half of FY26, given the global uncertainties, I think that number is also 10%. So on an absolute, basis, 10% growth rate given the uncertainty doesn't look that bad. And overall, we looked at the capex spend of in the first half of the year of 15%, which is some benefit of a low base of last year, but still is a very respectable number. So there have been worries around capex spending slowing down given some of the benefits that the government has been given to woo voters during state elections, etc. But I think government should, I would think that during the budget would still maintain 10% or 10% YOY budgetary allocation towards capital expenditure. Where will it go more? I think it more will be allocated towards defense and energy and railways, somewhere in that order is my thought. The other bit is we talk about macro. We talk about macro being stable, and how do we know macro is stable? One of the two things. One is the central government debt to GDP ratio, which did go up post COVID, but the glide path is towards 50% over FY 30-31. So I think government is well on track of that. So essentially, while you are growing, you are borrowing less, and your interest expenses should go down. So you'll have a lower deficit. So that is one. The other is and the result of that is obviously, among other things, spending less, is also that the government fiscal deficit is under control, and it continues to maintain that glide path to almost to 4.2% by FY28. So that glide path, I think, should be reachable, and the government. does have some leeway, but it may decide to continue with its glide path. It could well, as a surprise, it could well decide to push that 4.24% number, fiscal deficit number by 1 year. But let's see that over the next in the budget, which will be presented in the next 10 days. So that is the other bit. Just to come back to valuations, I think average P is around 10-year average Nifty P is 18%. So I think slightly overvalued zone, but this was since December, but over the last 3 weeks, we've significantly corrected. So probably we are around the mean there. So I wouldn't be too worried from an overvaluation perspective. I think we are, but then again, we are not cheap. I think it's important that we are not cheap. What is important is we should get the earnings momentum back. I think that is more important. Valuations will then automatically adjust, right? If you get better earnings, then valuations will automatically fall in sync. India ROEs are generally good, and we continue to trend there. So as earnings comes, obviously you will have better return ratios. So that is, return ratios are just a function of the earnings. That is the other bit. Just to look at sector wise, I think what is important, I think that's where somewhere to look. So capital goods does trade slightly more expensive than historical averages, but for a fair reason. I think growth in the sector is much more, there's a higher visibility of growth in the sector. Earnings have been strong largely, barring a few companies. Earnings been strong. Capex expenditure have been, beneficiaries of higher capex allocation in the union budget and the spends from the government thereafter. Autos again, continues to do well. Further demand is higher post the GST rate cut, etc. So you will see, the valuation in the sector a little better. Private banks are cheaper compared to historical valuations, while balance sheets are clean and credit growth should come back post this repo rate cut, GST spends, etc., and cleaner balance sheets of corporates. So their ability to take more risk is there. So we should see this could be an opportunity for private banks just from a valuation standpoint. Again, on the PSU banks, if I look, valuations may look slightly higher, but for the right reasons. Balance sheets are clean. They are competing for growth. Their NIMs are improving. So return ratios have significantly improved. Underwriting standards have significantly improved for PSU banks, so which is reflected in slightly higher valuations, but compared to the growth that we see here in the segment and the competitiveness we see in the PSU bank space, I think, and they've taken a lot of market share from the private banks actually. I think valuations are justified. uh, Pharma valuations are higher back on the CDMO space. I think some of these names do trade significantly higher. That CDMO opportunities, China plus one, etc. It's been a disappointment. The pharma sector has been a disappointment last year. Given the China plus one opportunity, I think will take longer than a lot of analysts expect. So that demand will come, but with some lag. So they trade, I think, versus the earnings, they trade. Some of the pharma stocks do trade expensive, while the macro story remains strong. Our abilities to do research, top quality research remains strong, but valuations, some of it is yet to be shown in the numbers. IT again, a bit of lackluster growth, so valuations did come down. Post-COVID, they significantly went up, but with the recent repeat, and also was on the back of the AI fears that the Indian IT industry may growth rates may be hampered, maybe actually be impacted by the whole AI thing. But some of those concerns are receding, and the Indian IT industry may be beneficial of this whole AI services boom that may come. Plus, the currency depreciation also helps. They've been one of impacts on this new labor code thing. But for that, sector has done slightly better than sort of the written down expectations we had from the IT companies. So we've been a bit underweight IT in our portfolios. Yeah, so this is largely that. Metals and minings again has done significantly well. Uh, we have been the beneficiaries of these some of the metal stocks that we hold in our portfolios, and the sector, the outlook for that has is positive. So obviously, stocks done well, the valuations have run up. So yeah, so this is this. So just to sort of for some of the other things, as I said, GST, the other bit was we talked about GST. The other bit was the rising UPI transactions, which again is a positive. The national highways that we've been constructing again leads to significant convenience, higher capex spending. Some of the money's been going there. Our energy consumption, this is I think something important, did go off in the summer months. So you've seen sort of a negative number here in the summer months on a YOY basis. So essentially, we're looking at energy consumption here on a YOY monthly basis. So we did see some degrowth here in the summer months. That was due to a strong shorter summer, longer monsoon, if I can say. But peak demand again in the month of December and now in January has been increasing of the order of 6-7%. So again, this year should be a growth year for the energy sector in our view. So that is something that we like and that we track the energy consumption. That I think that's a positive. The other one of the other highs will is the credit card spends. So they which have sort of come off against last year's. So part of this is due to multiple reasons. One was the slowdown in consumption. The other one was increased use of UPI. So which I showed in the previous. So UPI has significantly taken over. So you'll see higher value of UPI spends in the economy. So something has to give, and which is credit card. Some of the credit card spends have actually come off. Auto sales volumes have been strong both in the two-wheeler space and the PV space. So some of these things picked up strongly during the festive season. This while there's a bit of seasonality here, but over the long term, if you look since COVID, the graph has been on an upward trajectory. Credit growth should again pick up given the repo rate cuts. So all this transmission happens with a bit of a lag. So we should see that benefit coming in. Formal sector job creation is seeing some signs of turnaround. So you'll see the benefit of that in the formal economy, benefit in the consumption. So some of that sentiment, that index is looking slightly looking positive compared to last year. The other bit is the India Pay Commission. I'll not spend too much time here because I think we'll see if this happens or not, given the given the lower revenue receipts that the government will get on back of the GST, the immediate GST cut and the income tax cut. So this may get postponed, but if this happens again, this will be a boost for consumption. This is yet to be seen, and I'll not deliberate too much over it. We'll see over the next course of the next few days. So let's leave it for now. But this is something in the back of my mind also. Uh, about just this is about Nifty constituents. See, we are in the middle of the results season. Uh, we don't have the full numbers yet. The expectation was in the previous quarter, the expectation was around an 11% growth. So far, if we look, we are behind the target. So we are when I last tracked the Nifty 50 companies which had come with the results, we are looking at a revenue growth of around 5 to 6%. The impact they've been impacted by this labor code impact, which is sort of a one-off. But irrespective of that, we are in the 5-6% range. But having said, I think earnings cuts are behind us. From here on, I think earnings should start rising. This quarter, in that sense, has not been as exciting as it should be for various reasons, given global uncertainty, etc. But some sectors, like as I said, autos, etc. As we see the numbers, they should do some of those sectors of discretionary spending. They are doing exceedingly well for the numbers that we are tracking. Some other companies, energy companies, as I said, metal companies will have some costs, but again, higher realizations take sort of care of it. So the numbers again, there are positive for the numbers that have come so far. So that's the sort of background there. Uh, so yeah, so that was largely on the market, but again, there are risks to the outlook. So just to sort of uh, talk you through these quickly. One is the global slowdown. US so far has done well, but some of these tariff impacts, they've they've actually absorbed 50% of the tariffs themselves. Some of those impacts may come with a bit of a lag. So, while currently they're doing well, but some of the slowdown impacts will come. This whole confrontation between Europe and the US, and that attitude of the US government with Europe, I think does impact the global economy. That does impact investments, those kind of things. So, it doesn't those if they get prolonged, this is not a positive for growth. So those risks, if they get prolonged, I think that is important to track. Similarly, it's basically linked to the geopolitical tensions. You thought until last year you were limited to Asia and Eastern Europe, i.e. Russia, Ukraine, and Gaza, or Taiwan, China, but this whole Greenland thing, and now the Panama Canal thing, this is a bit of a unwarranted and unwanted tension. So this is something to keep a tab on. Unfortunately, there's no way to predict some of these things. But you can only keep a track of those things. And the other is obviously if some of these things rise, rupee becomes weak, and then you'll also see FII selling, which leads to a sort of negative impact on the markets. But I think I'll stop here for a moment, and I'll let Shailesh ask any questions that the investors have.
No, sir. Uh, so the first question which has come in the Q&A is that what about the US debt problem? Can it trigger correction in US which leads to correction here in India?
So it's not as easy as some of the investors, there've been news, they've been selling that Europeans will sell US debt and all. It's not, I think it's a little bit of a rhetoric. It's an immediate rhetoric. It may not happen. Uh, uh, and this whole US debt problem, if you're talking about the European investors selling US debt, I think that's not that doesn't seem to be happening. Whether so that immediately doesn't seem to be having, it's easier said than done. Okay, so the volumes are way too large. Volumes are way too large. Some of this is rhetoric. It doesn't actually, at least in the near term, it doesn't translate into action. And also the US government does realize that if it continues with this confrontational attitude, you can also have problems. You can also be impacted by tariffs. I'd say more common sense, hopefully more common sense will prevail.
Okay, sir. So next question is, what is the anticipation on earnings recovery view on Q3 earnings till date? Many heavyweights have reported their numbers.
Yeah, as I said, earnings been of the order of it's been slightly disappointing with some of the I think some of the banks could have done better. Some of the energy companies could have done better. So there's been a bit of a disappointment there. But if I look at autos, if I look at discretionary, some of the discretionary company numbers, they've been. So first was on the Nifty 50 bit, where so far of the 38-40% of the market cap, where earnings have been of the order of 5% growth, which is disappointing. We were looking at 8% growth. This is that. But as I said, but discretionary consumption continues to be strong. Those numbers, if I look, and which is may not be part of Nifty 50. But some of those numbers are good for the numbers that have come so far. So we're still in starting the earnings season. IT hasn't been as bad as it was sort of written off. They're still okay. Obviously, if I include the impact of the labor code, then yeah, earnings don't look. But if I include that, then it's relatively better, and the rupee appreciation also helps. And the fear of this whole AI capex impacting IT companies, I think that's also a bit of overdone. So overall, I think net we are growth outlook from here on is positive. Yes, it's been delayed by a quarter or two, but barring this international uncertainty, I think we looking okay. The second bit, if I can add, was also the earnings has also been a bit lower because, as I said, the top line has been lower. Simple for the simple reason that uh, the ability to pass on prices lower given the lower inflation. When your nominal GDP itself is 8 to 9%, expecting higher top line growth is also not possible. So we'll see some correction, as I said during the course of the presentation, that we'll see some increase in the the inflation numbers, and that should also and the nominal GDP. Nominal GDP was its lowest since COVID. So once the nominal GDP numbers also pick up, inflation picks up, you'll see better earnings growth.
So next question is on view on silver and gold.
We've not been in really, at least I'm not an expert there. Uh, it's it's as simple as that. So I'm not really an expert, but just as in one line, if the uncertainty continues, you'll see these precious metals doing well. If some piece of some sort is brokered, then you'll see a sudden correction. So essentially, that is the short answer, but not no real experts there. You know.
So next question is geopolitics, treasury dump, high debts, yield spike, inflation slowdown. What is these indicating? Uh, and should we overweight metals?
No, we are already overweight metals actually compared to in the index. Index is at 2.5%. We are 8%. So that has led to, so has helped us as portfolio managers are and investors obviously are investors obviously. So we are overweight metals in this market, and we continue to hold those names. In hindsight, one could have always thought, oh, while we are holding 9-10% as a weight, we could have done 20%. But these are very deep cyclicals. So beyond a point, you can't do that. And this also comes with the wisdom of hindsight. But irrespective, where the index is at 2.5%, we are at 9-10%. So.
Okay, so next question is what is your Nifty 50 target for calendar year 26 and what is the earning growth you are expecting for calendar year 26?
So I think I can talk more about earnings growth than Nifty targets. Nifty targets are relatively difficult. I don't have that vision. But and over a longer period of time, Nifty should track earnings, as simple as that. So if earnings are of the order of, I think earnings will be of the order of for these companies of the order of 11-12%. So low double digit is what we are expecting. So broadly, Nifty, other things being equal, Nifty should track that.
What will get FIs to come back to India?
Uh, just two things. One is earnings, better earnings, and a lower geopolitical easing of the geopolitical tensions. Again, all of these things are in some ways interrelated. Uh, uh, and obviously also the US tariff situation easing. We've signed FTAs with the UK. We've signed it with New Zealand. EU will be a big FTA if we get to sign it. The EU president just commented recently that will be a big one. So the size of that market combined is quite big. So that should aid our exports, and we hope if these FTAs are getting signed, then the government will make some exports, more, it will be a more export friendly budget, if I may say. Uh, so that should aid earnings, that should aid general growth in the or the GDP growth. So that is one lower geopolitical tensions. A lot of FIAs go by headline numbers. Better earnings obviously make our market on a forward basis cheaper. Uh, so more consumption, more capex, more private sector capex, which again is a function of low uncertainty in the market. So a lot of these things are interrelated, but some of these pieces falling together should help.
So view on on our existing PMS, what we are planning to do on our PMS.
So we've been adding names in the energy sector recently across our portfolios. That's one thing we've done. We've added some discretionary names where we found value. We've added, obviously, as I said, we've exposure to metals that we continue to hold. Financials has done well for us. Some of the bigger banks are public sector banks are almost trading at all-time highs where the market is under pressure. So that again, so we have significantly exposure to financials and a lot of public sector financials as well. And some of the NBFCs have done well for us. So we continue to hold us. We taking more selectively. So this is that. So we're taking more exposure to renewable theme, to the energy sector theme. That's, as I said over the course of the presentation. So that's a space that we like, given the low base of last year. That's what we like. We also taking exposure in select pharma names where we have more comfort. So those are the names that we continue to evaluate. We look at chemicals. There was a lot of noise last year, but the numbers didn't come mostly. So we'll also evaluate some chemical names. Yeah, and some discretionary, obviously, some discretionary names we continue to evaluate.
Okay, sir. So next question is, while we are fairly valued, which economy, in your opinion, is undervalued at this current stage?
But even I think even the Chinese markets, if you look at the numbers, there again they continue to be cheaper. I mean, you can look at many other markets, the Chinese and the even the some of the European markets are cheaper to us. A lot of markets are actually cheaper to us still. The Chinese, for example, or the European ones.
So next question is, given that Indian market is just range bound for the past 15 months, and given the global uncertainty triggered by US, is it wise to focus on debt instrument for investment in the short term, say for a year or two?
I mean, it's part of your, broad portfolio allocation. Debt is generally a part of your portfolio allocation. So, I can't comment there. It may be your wealth advisor may be better uh, place to advise you on your allocation between debt, how much you want to allocate to debt versus equity. So, but on our side, we are equity investors and we continue to invest in equities. We'll obviously, at some stages, we will have more cash when the markets are overvalued. And in other instances, we'll have less cash. But those are a function of the market valuations that we have at our side. But on your side, you may be best advised by your wealth advisor.
So next question is, view on precious metals.
Well, that we already discussed the gold and the silver bit.
Given the global situation, India is favorably placed for large global agreements. What will be impact on markets because of this?
No, impact on markets is generally, I think it does spur. So when you have these big FTAs, and if they are reasonably, the agreements is on relative, it's always a two-way agreement. But it does spur export growth. For example, I'll just give you an example. Government exports to European Union for a country like Bangladesh are, at least if I remember correctly, had no tariffs, while Indian government industry has a 10% tariffs until now. So once you have the FTA, that is a sector that will obviously benefit. So wherever we were not fairly placed, or we didn't have that edge over the competition. With an FTA coming in place, we are at least equally placed. So, you have a better chance of uh, growth in that specific sector that will benefit out of the FTA. So it'll be very specific, sector specific sectors that will benefit out of the FTA. Garments was one example that I gave. You will be at a level playing field versus some of the other countries which were no tariffs versus India at 10% tariff.
So next question is, which sector you are positive and which sector you are consciously avoiding?
So, we are not consciously as such avoiding any sector, where it's just that in some sectors there may be a capital goods valuation. Some of the capital good names, the valuations are high. So while we not evaluate, we continue to evaluate those names, but there generally the valuations are high at this point in time. Uh, the other where what we like is, as I said, we like financials. So we should look at strong credit growth. So that's a sector that we like. Valuations are still, I think, benign there. And we discussed it also over the course of the presentation. Financials we like, metals we continue to like. We like discretionary spending. We like pharma. Defense maybe also be a positive, but again, there we hold some names, but valuations are generally expensive. But that's also a space I think that will also, as I said, or in the budget, they'll get some allocation in the for the capex. So those are the places that we like.
So next question is, view on auto sector.
In the auto sector, our view is positive. We hold some names and we hold some auto names also. They are bigger part of our holdings. So that is generally, I think it's part of discretionary spending, biggest beneficiary of the GST rate cuts. So that's a sector we continue to like, and some of the names, hindsight, we should have held more. But we have some names that we are benefiting from. We continue to hold those.
At this stage, what do you feel or attractiveness on large cap versus mid cap versus small cap?
See, it is generally, I wouldn't actually go by large, mid, small. It's so we are not market cap per se allocators. Yeah, it is different strategies are where we have a all cap, which is more mid cap heavy, or whereas emerging, which is more small and that heavy. Uh, all caps are the large caps are relatively cheaper, uh, given the uncertain and plus the uncertain market environments. So that is that. The other bit is also that some of the small caps have sharply corrected, and we are also very, we are bottom up investors at the end of the day. So we look at from that perspective, and not necessary whether it is, unless until the fund mandates. So that aside, unless the fund mandates. Uh, Otherwise, we're also very bottom up investors. So we wouldn't be necessarily looking from that angle. Uh, so we'll be agnostic wherever valuations give us more comfort, we'll invest that. But the other bit also is that if an all cap PMS, yes, it is more largely a large cap play. So we will invest largely in the large cap space there, where we find comfort.
Uh, so the next question is, how about de-dollarization? View on that.
De-dollarization, uh, it's easier said than done. Countries have competing interests. There only some interests converge, but there have more competition than interest. So de-dollarization is difficult, and the US is also aggressive. At least not in the near term. I'm uh, I'm too bullish about the de-dollarization theme, not at least not in the near term.
So the next question is about Japan increasing their interest rates. Will FI be able to come back with funding become costlier to them?
Will funding become costlier to it does become costlier, yes, it does become costlier with increased interest rates, but the currency is also depreciated, so you also have to look at that angle of the currency also depreciating, so you also have the JPY INR angle also to look at, so on a net basis you have to look at it, so it's just not the interest rate that has gone up. It's also the JPY also has depreciated. So on a net basis, it may be flat. So I wouldn't just from that angle, I will not be too worried about the Japanese investors going away.
So your view on manufacturing sector?
No, I think we are positive on manufacturing as a space in the country. We've done a lot, but there are a lot to do. I think there is a lot of benefit from uh, global manufacturing shifting to India and this whole China plus one, even from the likes of the Airbus and Boeing doing a lot of their precision manufacturing in India. A lot of other companies doing precision manufacturing in India. Uh, Auto ancillary companies actually becoming engineering companies, not just being auto ancs, actually they translating into engineering companies. A lot of defense manufacturing happening in India. In that sense, I think we are positive. It's just that as Indian companies, we do invest less in R&D compared to our global peers. I think that is something the Indian promoters, I think, need to think about a little more. We've been borrowing or a lot of technology. I think we should be investing a lot in more, doing more of our R&D. So I think that's that.
Yeah. So next question is on Trump tariffs. So, we have been saying for last couple of months that it will happen, but for a couple of months there is no conclusion on that. So view on Trump
No,
tariffs.
it is difficult, while we've been saying, and rightly so, we've been saying, even the government also came and said, so who knows better than the Indian government, right? The Indian minister, commerce minister also comes and says it will be done by November. But you do, and then you suddenly also become positive when you got a new ambassador, American ambassador to India, which a position that was lying vacant. Suddenly you also become positive. Oh, this will help. But yes, it's been going on and for a while now. You can only hope that it comes sooner rather than later. You can't read the American government's mind, really, right? So even the minister, the government, Indian government itself couldn't read the American government's mind.
So the next question is, given the high inflation in the US, when is the Fed expected begin increasing the interest rates?
No, at the moment, they are in a more on a rate cut spree than think. But so I think that will be some time away. We're not really worried about, at the moment, they're pushing for interest rate cuts. They're not pushing for hikes, really. If you've been following the news with the president and the federal government, I think rate increase is some time away, in my opinion.
So the next question is, what catalyst will drive returns over the next 12 months?
No, it's the same things, what we've shown, easing of tensions, earnings growth, domestic consumption, more capex by the private sector. Those are the things. And some of the FTA agreements that we are looking for example, Europe and the US, this whole US situation easing, those are some of the factors.
So the last question is on our strategy. So what should investor, the current investor or the prospect investor, should expect from our PMS strategies, whether it be all cap strategy, which is predominantly large or mid. Then the other strategy we have emerging opportunity, which is predominantly mid and small cap. And the third strategy that we have is diversified alpha, which is more like 40% large cap,
Yeah.
30% mid cap, 20% small cap, and 10% micro cap. So considering these three strategies, if any prospect investors wants to come now or existing investor, what can they expect from these strategy for coming 1 or 2 years? And what can they expect from us? What will we are planning to do in those strategies?
No, so we are bottom up investors and we'll continue to look for opportunities that from a risk reward pricing perspective make sense to us. So that is what we can do on the fundamental side. Global macro is something that we cannot control. Uh, right? So global macro is something we can't control. On our side, we continue to be bottom-up stock pickers. Other things being equal, market returns should be slightly better than nominal GDP. If we are looking at a nominal GDP of say 11.5%, market returns may be better, slightly better than that. And for our portfolio companies, given that we look at earnings growth, higher earnings growth, I think our portfolios should do better than that. So this is on a steady state basis, but market is obviously has uncertainties which nobody can predict. For example, this tariff talk, we thought it'll be eased, but we ended up with 50% tariffs instead of tariffs reducing from the 25% that was originally imposed. So keeping those aside on a steady state basis, essentially we are looking, as I said, 10.5, 11% nominal GDP growth, market earnings growth slightly better, and we try to do better than that by bottom-up stock picking and including names that have higher earnings growth and better return ratios.
Okay, sir. Thank you, Hitesh sir, and thank you everyone for joining the call. Due to time constraint, we might have not asked a few questions, and there were a few questions on stock specific, so we generally don't take a call on stock specific questions. And thank you everyone for joining the call on a Wednesday evening. And we'll meet you guys again next month on our monthly market outlook in February. Thank you everyone. Thank you. Thank you, Hitesh sir. Thank you.
Thank you.
Bye.